What is up, YouTube? Tim Layton here, and welcome back to my YouTube channel. If you're new here, thank you for coming. It means a lot. Alright, now real quick before we jump into the video, I just want to say I changed things up a little bit. I got a ring light right here for some consistent lighting, because previously I was using the sun, which is notoriously unreliable to provide consistent lighting, but now I'm looking pretty good, if I do say so myself. I also threw a skateboard back there with a little blue light behind it, kind of make things a little pretty. I'm not going to spend too much money because I only have 15 subscribers and I don't want to dump hundreds of bucks into making my videos look too nice when I'm not getting paid for it. But anyways, that's beside the point, so let's get into it. Alright, so today we're going to be talking about the January CPI results. The Consumer Price Index, in other words, the inflation for January of 2022. So we're going to go over the numbers and what they mean, how they're looking, and then we're also going to talk about how I think the stock market and the Federal Reserve are going to react to those numbers. So let's get right into it. All right, so jumping right into this, the CPI, Consumer Price Index results came out at 0.6% for the month of January 2022 and 7.5% year over year. That is an increase from 7% year over year in December. Now that is compared to the estimates, what people thought it was going to be, of 0.4% for the month of January and 7.3% year over year. So that's not really looking too good for us, although you wouldn't really know that by looking at the stock market, because as of the time I'm recording this video, the S&P 500 is only down 0.3%, Dow Jones is down 0.2%, and the NASDAQ is only down 0.18%. Alright, so the reason I said it's not looking too good, although estimates were at 7.3% for the year and 0.4% for the month, and it was supposedly priced into the market, meaning the market has already dropped in anticipation of inflation being at 7.3%, any articles you would have read or any YouTubers you would have watched, most of them believed that we were actually going to beat those estimates, meaning we were going to come in below 7.3%, not over it. And the reason they believed that was through unofficial sources like company earnings. A lot of companies have been missing their earnings, suggesting that people are spending less money now. Also, trending Google searches. Google searches for home loans and auto loans are at a low for the year, meaning that people are searching less and less for home loans and auto loans, suggesting that people are buying less cars and houses. Because I know personally, if I was about to buy a house or buy a new car, I'd be Google searching everything I could, finding out all the information I can about home or auto loans. So the fact that people aren't Googling that stuff suggests that people are spending less money. So like I said, although the estimates were 7.3%, I think most of the market expected under 7.3%. So when it came in at 7.5, I really expected the market to tank. But it really hasn't. You would have no idea that the CPI came in at 7.5% looking at the stock market. Alright guys, so here's what troubles me so much about these January numbers. January was supposed to be our month. We were going to prove to the Fed that inflation wasn't as bad as they thought it was, and that we could do this on our own. We had a perfect storm. We had Omicron fears, we had the stock market tanking, and on top of that, it was right after Christmas, where people statistically spend less money. So that was a perfect storm for us to have a low inflation month, push those numbers out to the Fed, and then maybe we could trick them. Like, oh, inflation's not that bad, see? Now obviously they were still going to raise interest rates because inflation is still high, but we could coerce them into thinking that inflation wasn't as bad as they thought it was, and maybe they don't got to raise interest rates as high as they initially thought. But unfortunately, that's gone now. In February, that's definitely not going to be our month either. Let me show you guys why. Alright, so first of all, if you take a look at this graph here, you'll see that from September to November, we were on this steady uptrend. But then in December, that uptrend actually slowed. Kind of appeared as if it was rounding off. And we were really hoping that it was going to either keep rounding until it was flat, or maybe it was even going to round downwards into a downward trend. But now, with January's results coming out, it's actually continuing the uptrend back again. And the Fed's not going to like that. They don't want to see upward inflation. They want to see downward or steady inflation. Now this one to me is the real kicker. If you look at this graph right here, this is a 1 month change in the CPI for the last 12 months. Now if you look at January of 21, inflation came in at 0.2%. But now next month, when February's CPI comes out, this January 21 is going to get kicked off. Now this January 21, this 0.2% has been our little anchor. It's been bringing down our average of the year-over-year CPI because it's so low. But once we kick that off, it doesn't even matter what February CPI comes in at. Unless it comes in lower than 0.2%, our CPI is going to raise. And if February is anything like December and January and comes in at 0.6%, we're going to be seeing a 7.9% year-over-year CPI. And since the market's been recovering now and nobody's scared of Omicron anymore, we might actually even see an increase to a 0.7%, which would give us an 8% year-over-year CPI. Now, I'm not going to lie to you guys. If I see an 8% CPI, I'm going to be a little scared. I'm not going to be happy about it. And the stock market's not going to be happy either. And the even shittier part about that is February CPI numbers are going to come out March 10th. Now, the Fed is going to raise interest rates for the first time on March 15th. So pretty much without a doubt, February CPI is going to be higher than January CPI. Year over year at least. And the Fed is going to see that 5 days before they go to raise interest rates for the first time. And my fear is that they're going to see that and they're going to think we need to take action now. Even though it's just kind of an outlier from the 0.2% January 21 getting kicked off the data, they're not going to care about that, I don't think. And they might overreact and overcorrect. And the stock market's also going to hate that. I don't know, guys. I just don't have the best feeling about this. But that's pretty much it for the CPI results. Those are the numbers. The stock market hasn't seemed to care yet. I don't know if they're going to care. You'd think they would because 7.5% wasn't priced into the market, but nobody's caring yet. But I do know that the Fed is going to care. But we just won't know how much they care until March 15th when they have their next meeting. So, yeah, it's not looking too good, but worst case scenario, the market drops and we just get to buy the dip, right? That's my plan anyways. So thank you guys for watching this video today. I hope it was an informative update, and I'll see you guys tomorrow.